Okay, let's dive into this. Welcome to today's Explainer. We're tackling a subject that honestly catches so many people completely off guard. Now, if you're watching this, you probably already know that changing your state residency isn't just about packing a few boxes and updating your mailing address. I actually want to read a quote directly from our source material today because it perfectly captures the whole tension of this situation. And that brings us to Section 1, the clean break myth. Simply fleeing a high-tax state in 2026 is essentially an illusion without the proper documentation. The source material really emphasizes this point. A simple, quiet departure? It's just no longer a viable strategy. Instead, it's actually a high-stakes residency audit trap just waiting to happen. The state you're leaving doesn't just take your word for it. They don't just say, "Oh, you moved, great, best of luck." Let's look at Section 2, the statutory resident trap. Now, what's really interesting about this slide is understanding exactly why this is happening with such incredible intensity right now. Our source for this, a CPA named Brian from Hidden Tax, points to the staggering national debt, which is currently sitting around $39 trillion. To put that into perspective, it's a massive amount of macroeconomic pressure. And looking at this objectively, the source argues that this pressure eventually translates down to the local level. The claim here is that states are finding themselves increasingly desperate to fund their own budgets amidst this massive national debt environment. So they just have to look for revenue wherever they can legally find it. And according to the source material, one of the primary ways they're finding that revenue is by looking backward. The suggestion here is that high-tax states are aggressively utilizing residency audits to actively siphon wealth from former residents. Basically, it's a way to combat those budget crunches, and they aren't doing this arbitrarily either. They are using very specific, heavily resourced audit divisions whose entire job is to scrutinize people who claim to have recently moved away, just to see if they can drag them back into the state's tax net. So the absolutely crucial point here is understanding exactly how they drag you back. The core legal mechanism auditors use is this classification right here. Statutory resident. This allows states to tax your global income. We're not just talking about what you earned in that state, we mean your income from everywhere in the world. And they can do this if you meet two specific criteria. You maintain a place of abode in the old state, and you spend enough time there. And that's completely regardless of whether you physically moved your primary life to a new state. This legal definition, that is the invisible trap and the core weapon auditors wield against you. Moving on to Section 3, domicile versus physical residency. And this brilliantly illustrates the critical nuance you absolutely have to understand to survive a state residency audit. Physical residency is simply where your body happens to be on any given day. It's temporary. Domicile, however, is what the auditors really care about. Domicile is where your paper trail definitively proves your permanent intended home actually is. You can have multiple physical residencies, but legally speaking, you can only have one domicile. And here's the kicker. The burden of proof is entirely on you to show that your domicile has fundamentally shifted from the old state to the new one. If your paper trail points back to the old state, your physical presence in Texas or Florida means absolutely nothing to the taxman. Which brings us to Section 4, the 183-day math. I want you to frame the information we're about to cover next as your magic weapon. It's exactly what you need to defeat that statutory residency trap. 183. Burn this number into your memory. The math here is remarkably simple, but the consequences of getting it wrong are just devastating. This number represents the absolute threshold of days you can spend back in your old home state before you automatically trigger that massive tax on your global income. It's essentially half a year plus one single day. If you cross this threshold, the state legally views you as theirs for tax purposes. Let's reiterate this rule clearly so we're all on the same page. Keep a place of abode, and by the way, that could be a vacation home, an apartment, sometimes even a long-term hotel setup depending on the state, or spend 183 days back home, and they will tax your global income. Understanding this math is the very first step to building a secure financial fortress. If you don't track your days meticulously, you leave the door wide open for an auditor to estimate your days for you, and trust me, their estimates are not going to be in your favor. Let's move to and see how this builds into Section 5, building your paper trail. Now, this is where the actionable reality kicks in and the real work happens. Step 1, legitimately nickel and dime your paper trail. Our source CPA advises that you must be incredibly meticulous here. You need to document literally everything. Step 2, change your voter registration. Where you vote is a massive indicator to auditors of where you consider your true domicile to be. Step 3, switch over your utilities. If you're keeping the lights and the internet on in a house in your old state under your primary name, it signals to an auditor that you never really left. You have to prove, document by painstaking document that you have truly escaped their jurisdiction. I want to share this final piece of advice directly from our source material. Don't let an exit audit crush your financial fortress. Stay disciplined, trust the math, and keep your money in your hands. Staying ahead of that audit siphon isn't about luck. It requires absolute, strict discipline regarding your new domicile. You just can't be lazy with the paperwork. You have to treat the establishment of your new residency with the seriousness of a high-stakes legal defense, because ultimately, that's exactly what it is. So I'm going to leave you with this final, provocative thought to consider. Take a look at your own paper trail. Look at your own records, and ask yourself honestly, have you truly escaped, or is your old state still reaching into your wallet? Thank you so much for joining me for this explainer. Keep learning, stay focused, and I'll catch you next time.